High dividend ETFs, or more specifically covered call ETFs, they have been extremely popular these days, and it's easy to understand why. I mean, they pay crazy high dividend yields. I've seen some, paying 80, 90%. That is just unbelievable. It seems amazing, right? Almost a bit too good to be true. So I had my skepticisms, but before I completely dismissed this investment, I decided to do my research. So in today's video, I will share how these ETFs work, why they entice so many people, and why I don't want to invest in them. Let's get to it. So first of all, how do these ETFs work? How are they able to pay out such high dividend yields? It seems like a hack, right? Well, after all, these dividends, they are made for the sole purpose of generating income for their investors. So it's not a scam. I'm not calling these ETFs a scam. They are definitely a legit trading strategy. But to do this, they use an options trading strategy, and it's not something that I will explain in this video because it can be quite complex for you guys to follow, but I have traded this strategy before, so I am quite familiar with it. But for those of you guys who are interested in learning how they manage to do this, the strategy is called covered calls, or more specifically, I've seen these funds use a variation of it. It's called the poor man's covered call, which is a funny name, right? Poor man's covered call. But yeah, essentially they are selling options to generate income, which they then use to distribute to their investors. One thing that you should know though is that when you invest into these ETFs, most of the times you don't own the underlying asset. So let's say you own the high dividend ETF for Tesla. I think the ticker symbol is TSLY. You don't actually own any shares of Tesla because this fund, they don't own shares of Tesla, they only own options of Tesla. So if this is not your thing, then yeah, these ETFs will not be for you. A lot of the ones that I've seen these days cover individual names. So I've seen them on Tesla, Nvidia, MicroStrategy, Coinbase, basically all the popular retail names that have been doing extremely well. But there are also some of them that act more like ETFs. So instead of just selling options on one company, they sell options on many different companies. And I think the most popular one is the one by JP Morgan called JEPI. And to be fair to them, they have been around for quite a long time. Anyway, these ETFs, they have gained popularity in recent times. And like I said, it's easy to understand why. We don't even have to look so far. I know that for a fact, Malaysians, we love our dividends, we love our passive income, which is why we love investments like ASB, FD, money market funds. Even when we're talking about stocks, we like dividend stocks like Maybank, right? We love getting that source of passive income. That is what investments feel, or that is what investments should be like for us. Most people seem to prefer this idea of, getting this passive income compared to getting capital gains, where the value of your portfolio just goes up and up and up, but you don't get any payouts. Which is why a lot of people, when they ask me S&P 500, how much can I get a year? Well, there's no payout. So it completely depends on how the asset performs, which I guess a lot of people don't like, right? When we talk about ASB, when we talk about EPF, you know roughly how much you'll be getting a year, and you'll be getting it in cold, hard cash. So these ETFs, they seem like a hack, right? They seem like, wow, the financial industry finally figured out a way to give me passive income with crazy yields. Like I said, if you're getting 80, 90% dividend yields a year, it means that in just a year, you can almost recover your entire investment. If you invested 10,000 ringgit, in just a year, you will get 9,000 ringgit, right? It seems like an incredibly good deal. Well, for one, just know that the yields that they're paying out right now, it is not sustainable long term. It really depends on the options premium. But again, I don't want to go too deep into that because it can be a bit confusing. Yeah, just know that yes, they will be able to pay out high dividends, but it won't be as high as 90% forever. Anyway, there's also the fact that social media has posted a lot about these high dividend ETFs. I've seen them myself a lot on Twitter. And I'm not gonna lie, even I get tempted, right? I've seen these guys with, I'm pretty sure it's a $10 million portfolio at least. And he's sharing how he's getting dividends in the six figures every single month. $100,000, $120,000 every single month from dividends. It just seems so enticing. But after doing the digging, after doing the research, I figured out the harsh truths about these ETFs. And this is why I personally don't want to invest into them. So the first thing that you need to understand is that dividends, it is not free money. Dividends comes at the expense of capital growth. And it's not just for these ETFs, it works for any asset class out there. When it comes to ASB, EPF, every time they pay out the dividends every single year, it's not that the money came from nowhere, they are taking it from their cash pile. To illustrate this example further so that you guys can understand, Maybank is a very popular dividend-paying stock in Malaysia. I know a lot of investors love investing to them because they pay out 6 to 7% dividends year after year. But this money doesn't come out of thin air, right? It comes out from Maybank's balance sheet. It comes out from their assets, which is cash. So every time they take out this cash and pay investors, technically, now they have less cash, so the value of the company has gone down by the amount that they paid out in dividends. And that is why when you look at the chart of Maybank, you can see that every time they pay out dividends, the stock price gaps down. Which means that if they pay 20 cents in dividends, the stock price will gap down by 20 cents. Which then essentially means that dividends is not really extra money. It's not really free money, right? It's essentially almost like you're selling the shares. Yes, you are getting 20 cents, but the value of investment is also going down by 20 cents. So net, you're not up, you're not down. It is just you selling your shares. So for these covered call ETFs, it works exactly the same. Every time they give out these distributions, it means that the value of the fund, it doesn't go up and up and up forever, which means that you are missing out on compounding growth because, like I said, it works almost like you're selling shares. You're selling shares of the company by receiving that income. And because they do this, it also means that whenever the stock or the underlying asset goes through a drawdown, it will be very difficult for them to recover. Because imagine it like this, when the share price goes down and down and down, they are still generating income, they are still paying out dividends. So they are selling shares as the price goes down, which means that when the price goes back up, they don't recover as quickly. Instead of just saying, trust me bro, let's look at a comparison of performance. If we look at the S&P 500 ETF, VOO, the return over the last 5 years is 88%, which is crazy, right? But if you look at a high dividend version or covered call ETF of the S&P 500, we can look at XYLD. And if we look at the price performance over the last 5 years, it is down by 12%. One is positive 88%, one is negative 12%. Yes, XYLD is paying higher dividends, but when you compare it on an absolute basis, it has underperformed the underlying asset, which is the S&P 500. So yeah, don't expect the value of your portfolio to go up because, like I said, they are paying out distributions. And because we had that bear market in 2022, the ETF XYLD, it has just not been able to recover. It's still not at all-time highs, even though the S&P 500 itself is way past its all-time high. And it's looked really good this year, and it's enticed a lot of people over the last, I would say, 2 years because the stock markets have only been going up. When it's up only, of course, everything looks good. You're getting the high dividend payouts and you're even getting capital growth, right? It seems like a hack that you've unlocked. Well, the fact is, one, if you own the underlying asset itself, let's say you own Nvidia stock versus owning NVDY, which is the covered call ETF, Nvidia outperformed even despite the high dividend payout from NVDY. Number two, when a bear market comes and it's guaranteed to come in the future, Nvidia, the share price will drop, but it can recover. NVDY, when it drops, is going to find it extremely hard to recover to its old prices. Even with the dividends that you get, you will still underperform most of the times. The only scenario from doing my research where this covered call or high dividend strategy works out is in a sideways market where the prices are not going up, it's not going down, it's just moving sideways. But then again, when we start talking about that, it becomes more like a trade rather than an investment because how do we know where the markets are going to go, right? How do we know when it's going to move sideways? By the way, if you guys want to invest into US stocks and ETFs, including these high dividend ETFs, then check out Mumu. They are a regulated broker in Malaysia and I'm using them myself for my long-term investment portfolio. If you guys are interested, the link is in the description of this video and you'll get some nice freebies if you sign up with my link and make your first deposit. Anyway, so why do I not want to invest into these ETFs? So to explain this, I must first explain what actually matters to me. As a young investor, as someone who is still in my 20s, nearly 30s, I guess, what matters to me when it comes to my investments is the total portfolio growth. How much money is my investments going to be worth in the future? I do not need any cash flow now, right? Even if I make an investment and it pays me out a dividend right now, it's not like I need the cash. So I don't want to be fooled into these investments where, they promise payouts. Again, it's not like it's a scam. It's not like they're promising payouts, right? But I don't want to be fooled into investing into these high dividend yield, high payout investments at the expense of my long-term capital growth because that is the most important thing to me. And it's clear that holding the underlying position itself will outperform over the long run compared to investing into the covered call ETF version. And to verify this claim, I asked ChatGPT to do a simulation of holding the Nasdaq ETF versus holding the Nasdaq ETF but the covered call version. So to be fair, in both scenarios, ChatGPT is generating an income for the investor. For the covered call ETF, it's just receiving the dividends. For the outright position of Nasdaq 100, because the dividends are not enough, ChatGPT is simulating me selling the shares of the Nasdaq 100 to generate the same amount of income. The result? Well, you get the same amount of distributions every single year via both. One is via dividends, one is via selling the shares. But at the end of 10 years, holding the underlying position will mean that the value of your portfolio is 3 times higher. So based on this simulation by ChatGPT, holding Nasdaq 100, you have a $300,000 portfolio. Holding the covered call ETF, you only have a $100,000 portfolio. Now, I'm not saying that these covered call ETFs are a scam. It's not like they're going to zero, right? It will still hold some value and you will still get those juicy dividends. But you need to think about it, as a long-term investor, as someone who is young, who doesn't need this cash flow. Is it worth it getting these high dividends at the expense of, losing out on portfolio growth? You can see that this guy who invested in the covered call ETF, he only has 30% of what he could have had. The value of his portfolio is now a lot lower. I know that a lot of people think about passive income when it comes to the investments because we're thinking about retirement, right? When we retire, we need that passive income. Well, the thing is, if you own shares and the price has gone up by so much, you can always sell them to generate your income. And I know that some people will make the argument, no, you can't sell shares. What if you're in a bear market and prices drop by 20%? How are you going to sell your shares then? Well, you can still sell. It doesn't matter. If your portfolio is big enough, let's say you follow the 4% rule, where every single year you only sell 4% of the value of your portfolio for you to, live and use that as your income, then you will be fine. They have tested this over many different market conditions, bull markets, bear markets, whatever it is. If you follow the 4% rule, you should be able to last at least 30 years without having any issues. In most scenarios, you can actually even have more money after withdrawing the 4%. So if you decide to chase high yields now rather than capital gains, then you will be missing out on a lot. Especially if you're someone who is in your 20s, in your 30s, in your 40s, you will be missing out a lot on capital gains over the next 20, 30 years before you hit retirement. And yeah, maybe this is what you want. Maybe you want passive income now. But like I said, for me, the main priority for my long-term investments is capital gains. I want to make sure that it becomes as big as possible by the time I retire. My point of view of getting passive income for retirement is that I would rather invest into growth right now, maximize the gains, make my portfolio as big as possible for when I hit retirement age, and then when I need the income, I will just sell those shares. This is also why dividend investing is not for me. I don't invest into anything just purely for the dividends unless or except when it comes to the Malaysian stock market because it's a whole different ballgame. Having said all of this, when could it make sense to invest into these covered call ETFs? To me, there are only 2 scenarios. One is, like I said earlier, if you take this on as a trade, let's say you're really good at technical analysis, you're really good at macroeconomics, and you think that the stock market or this particular stock is going to move sideways over the next 6 months, then yes, by all means, own the covered call ETFs, you will outperform because when the stock price is doing nothing, at least you're getting some income. The second scenario where this might make sense is if you are an older investor and you are retired, rely on your investment portfolio for your income, and you want a nice juicy dividend yield, then yeah, maybe this will be worth it for you. You could consider this. But again, personally, I would rather invest in the underlying asset and then sell it when I need my income. When I first started out investing, dividend investing was actually very attractive to me. Psychologically, it just feels a lot better getting dividends, right? It feels like my money is working for me. It's paying me back. Compared to investing for growth, where the value of the investments just goes up and up and up. I mean, what can I do with that, right? I mean, yeah, it feels good. I can see the value of my portfolio go up. But when I get dividends, I can then decide to splurge. It feels like a bonus, right? I can buy things for myself. I can do whatever I wanted with it, which is why I like the idea of passive income initially as well. But the more I invested, the more I learned about all these things, something clicked for me where I realized as a young investor, investing for the long term, the only thing that should matter for me now is the total growth of my portfolio, not how much income I'm getting. I can settle that later on. If the value of my portfolio is 10 million ringgit when I hit 60 years old, then income is not a problem. I will figure that out. And the only reason I invest into ASB rather than putting everything into stocks is because I consider the money in my ASB as my emergency fund or like my cash savings, because at the end of the day, we still need some access to cash, right? So yeah, these high dividend covered call ETFs, they look sexy, they look amazing, they look like a no-brainer, but really think about it before you add it to your long-term investment portfolio and see whether it meets your investment goals. Anyway, let me know in the comments below, do you guys own any of these ETFs in your portfolios? I won't judge you, I promise. Thanks for watching this video to the end, guys. Give me a huge thumbs up if you enjoyed it and subscribe to my channel if you haven't already. See you guys in the next one. Peace out.